I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, enabling an enterprise view of exposure. Most of the time, most of the people working in insurance and reinsurance are way too busy doing their jobs to stop and think and engage with the big ideas that are driving the markets that they operate in. One of the great luxuries of being a journalist is that it is our day job to talk to the people with the big ideas and report back to you. And these days, with the podcast medium, you get to be right in the room with me when I talk to those people, and you can hear and learn for yourself firsthand. At this 1st of January reinsurance renewal, pricing fell sharply. That's interesting in itself, but it's far more interesting to be able to talk to someone whose job it is to work out what made that happen and what this means for the rest of the year and beyond. We can all see when it's rained, but it's far more useful to know what forces are driving the weather and to get some idea of whether we need to pack umbrellas for the morning commute tomorrow. David Flandro is the head of industry analysis and strategic advisory at Howden Re. To put it simply, he's one of the smartest people in our business, and it's his job to analyse and think hard about our sector and tell us and his clients what he sees. And if you've heard him on the podcast before, you'll already know that he's also great fun to spend time with. Howden Re have an excellent 1-1 report out. It's called Rebalancing. There's a link to the report in the notes. I recommend you stop and download it now and give it a quick read. Then come back and listen to the podcast and then reread the report. It's really comprehensive and will prime you for the year ahead in globally important topics way broader than just insurance and reinsurance. So if your New Year's resolution was to learn more about how the industry you work in really works and how it really fits in with the global economy, then this one is for you. Enjoy the podcast. David, welcome back to the Voice of Insurance.
Thank you. Wonderful to see you as always, Mark.
Well, what happened at 1/1/26?
This was a very memorable renewal. I think it's one that will stick out in my memory. And I am thinking about that in the context of my first big renewal, which was the post-Katrina renewal. It's not as memorable as that, but definitely this is a renewal where the market shifted and rebalanced. And so just to give you the numbers, we had negative 14.7% on risk-adjusted property cat, property retro down 16.5%, DNF down 17.5%, and then London market casualty down 5 to 10%, with U.S. casualty renewing mostly on expiring terms. So that, in general, those are big declines. And if I had to characterize it as succinctly as I could, I would say that the supply curve shifted a lot more than the demand curve. Although the demand curve did shift a little, it really was capital supply, reinsurance supply, in addition to the cost of reinsurance capital, that drove pricing lower at this renewal. It was a very late renewal, and it didn't...
Does that mean, does it just late just means that people thought they would get a better deal if they hung out longer?
I guess
right?
We always say that, don't we? We always say that it was late, but it really was late.
Well, I suppose it's only not late when it's an incredibly hard market, and it's been obvious from Monte Carlo onwards that it was going to be a hard market, and so you might as well get your order in if you want it filled.
Yeah, that's right. But I will remember this one, really, because I think thinking back over the post-Katrina renewal, the post-financial crisis renewal, the post-Tahuku renewal, and then, of course, January 1st, 2023, it really did signify a shift in the market. And that's why...
What's your headline on the report? Obviously, we have a link to the Howden's excellent 1-1 report, which I've read it. I've been lucky enough to read it before we had this conversation.
Yeah.
So what did you call it this time?
We called it rebalancing, and that's a portfolio term, obviously. This renewal really did mark a rebalancing in many ways, not just in pricing, but in terms of the way people buy coverage and the amount of coverage, how people compared to the cost of reinsurance to their cost of capital, and then just where the market went. I mean, we're clearly now in a market where there is downward momentum, and the question now is, where is the floor? What is the hurdle return? We had loads more supply, and that really was a function of a number of different things. The first thing, of course, was retained earnings. It was a profitable year for reinsurers. So if you just look at traditional capital, which goes up after dividends and share buybacks.
There's more money because there's all that. On top of any other money that's been raised, there is profit. And most CEOs... Obviously, it would have been no surprise to anyone who listened to the Monte Carlo podcast where we were having our conversation then. Every CEO I spoke to from a reinsurance side of things said, I want to do more of this good stuff. And I suppose ultimately that's the paradox. If we all say that, something has to change for us all to deploy that capital. And what has now changed is we're talking about minus 15 on property cat and down nearly everywhere else. Okay. And holding steady-ish on US casualty was being about the only holdout.
That's right, in terms of price. And that's manifestly a function of greater supply, which is a function in turn of earnings, is what I was just saying. And the other factor, of course, is the record ILS issuance and the record level of ILS levels, right?
The ILS market, the cat bond market, is now, when you add up all the outstanding limits, most of these deals are sort of 3-year deals, but you add up all the deals that are still live and the deals that were issued in 2025,
yes,
we're coming to a limit that is bigger than it's ever been before.
Yeah, that's right. So outstanding issuance, net new issuance, traditional capital, throw in the ILW market, and even by our very conservative estimate, dedicated reinsurance capital is now above $500 billion for the first time ever. And that is in contrast to reinsurance premiums, which we can measure more or less with metaphysical accuracy, which stand at around $450 billion. So we've now got more capital than premium in the market. The supply curve has shifted. The demand curve has behaved a little differently. But if you believe that price is a function of supply and demand,
surely this year has to be proof positive that is the case.
I think that's right, yeah.
But there's also the psychological side of the market, is that people were genuinely happy to be in the market and to do more in this market. And they knew they had to roll up their sleeves and trade something, and they were trading price.
Absolutely, yeah, that's right. So in contrast, say, to terms and conditions, price this time really was the driver of the lower rates online.
Well, that's a really, really good summary. So just to get on the numbers, supply is over $500 billion of dedicated reinsurance capital.
Yes.
So generally, in terms of supply, what sort of percentage increase we were talking about, and how did that stack up against? There was a bit more demand, one presumes.
The capital supply increased by about 8% in terms of the dedicated capital. It went from last year, $463 billion, to just north of $500 billion this year. So that's a significant increase. Remember, at 1/1/23, I think we had a 17% impairment, and that was largely a function of interest rate increases and the impairment to other comprehensive income on the balance sheet. But we've clearly recovered. I mean, we started recovering from that immediately the year after. And now, as I said, we've reached all-time highs in terms of capital levels in the sector.
And in terms of the demand, obviously we had some form of pent-up demand because we had frustrated buyers a couple of years ago.
Yeah.
Presumably there aren't any frustrated buyers anymore. They've had a very clear option to buy more at a lower price.
Yeah.
What sort of increase in demand would you say there was?
Well, this is a really interesting question, Mark. And actually, we said, I think, in the report that basically there was almost a binary behavior. On the one hand, there were definitely cedents who did, as you said, and bought more coverage because they've been wanting to have that for the last couple of years at levels where they couldn't get it. On the other hand, there were plenty of cedents that decided to just take the savings and put the money away for a rainy day, maybe later on this year. So what does that tell us? It tells us that insurers, cedents, are starting to think, or they're always thinking, about the cost of reinsurance in the context of the cost of all forms of capital on their balance sheet. If you're a really big insurer right now and you have a cost of equity of 7 or 8%, maybe the decline in reinsurance isn't yet attractive enough for you vis-a-vis your cost of equity and your cost of debt, and you're going to wait and see what happens, particularly given your own hurdle rate. So I think that right now there's still an element of the market that's assessing the cost of reinsurance relative to the cost of capital. So
it's not that accretive to buy more insurance at the moment.
It really depends on...
And of course it depends on who you are and how you're stacked up.
And also line of business, right?
Yeah.
So it's a different discussion to be had in casualty than it is in property, for example.
So what's changed? Obviously, we knew 3 months ago reinsurers were very bullish, excited, wanted to do more. If they're making sort of 17, 18% returns on equity this year, they'd have had to go into those negotiations, as we said, roll up their sleeves and give something to get something. What did they give if they had an internal hurdle?
Yeah.
It was 15 or whatever it was, say, thus far but no further. And, if something comes in and it's theoretically 14.5% return, I'm not writing it. What would that number be now?
Well, this is really shifting around a lot, and I think you're getting to the crux of the question that...
It's the core question. How much happier were reinsurers and therefore happier to take a potentially lower return hurdle to keep their share, to keep their clients happy?
You cited this return on equity, right? We've heard a lot about return on equity and high returns on equity and 17 or 18 or whatever the number is. This is important, clearly.
I mean, you have a slightly different way of looking at it. Certainly in your report, you look at economic value add, don't you?
We do. We think that's much more important because return on equity is just an accounting measure, and it's basically the return on one form of capital that reinsurers have. The real number that you need to look at is return on invested capital. And then even more importantly than that, you have to think about the cost of capital, the opportunity cost of capital.
Yes.
So the return on invested capital minus the WACC, the weighted average cost of capital, that's the theoretical return hurdle that you need to get your head around. In a year where people are making 20% on their 401ks or whatever. Are you going to deploy capital into a reinsurer that's got a 15 or a 20% return on equity? Maybe. But what you really have to look at is, what is my return on the entire balance sheet, including, by the way, contingent reinsurance? And then what is the opportunity cost of that capital? And this then gets us into a broader discussion around dividends, share buybacks, M&A, and hurdle returns, and where's the floor? So actually, that's the question that we've been asking.
So we've got a cushion. What sort of cushion are we working with at the moment? And then how much is that cushion being whittled down?
In the report, we've tried to measure this using public data because we can, of course, measure weighted average costs of capital looking at public data. But in the report, there's a chart, the economic value add chart, and it, of course, shows the peak in 2023 and 2024. These were, if you will, the vintage years for reinsurer profitability, both on an accounting basis and on an economic basis. We have now come down quite some way from that. And again, I'm talking about economic value add, but we're still above zero. We're still making positive economic value add, which by definition means that you should continue underwriting if you're making positive economic value add. So we haven't hit the floor yet. We haven't hit the hurdle return yet. It will vary reinsurer by reinsurer. It will vary class by class. But we still aren't anywhere near where we were, for example, in 2017, when we were manifestly destroying value in the reinsurance sector. And we don't want to go back there, and we're not. Right now, if you believe that analysis, then more premium equals more value at this point. That might be why reinsurers continue to be relatively enthusiastic, even though prices are coming down.
Where do we go from here in terms of at 1/1/23? We really reset the market.
Yes.
In rate, attachment point, and we've had a couple of years when we had a hard market softening, perhaps last year.
Yes, that's
now
right.
We've really reset. If we've gone back to 2022 levels in general, but we still have the benefit of those attachment points being where they were. What do we do now? Should we expect to see reinsurers gently digging their heels in from this point and trying to say, we don't want a massive sine wave. We know there's downwards momentum, but this momentum has to stop, doesn't it?
Right. So this is the question that everybody wants to
answer.
And
how do we stop that from happening?
Yeah.
Because we've seen this movie before.
We've seen this movie at 1196. We saw the same movie at 1104. We saw it again at 1108. And we saw it again at 1114.
Yes.
So...
And none of anyone's favourite vintage years, really, necessarily. Although 04 was pretty good. But
so in the 90s, we got to this point and we kept going down.
Yeah.
And we reached the trough. In the 2000s, at 1104 and at 1108. At 1104, of course, we went up because we had the frequency and severity events.
We had Ivan and a few other things, yes.
6 big hurricanes right in a row. And then at 1108, after that, we had the financial crisis. We had the plateau in rates. In fact, people forget we plateaued for 4 or 5 years after that. When we got to 2014, we fell quite rapidly all the way down to the trough of 2017. So the question is, here we are now, and I guess if you just want to look at it in terms of pure rate on line change, where we are now is most akin to where we were at 1109. What happened subsequent to that was completely dependent on events, dear boy events. So the question is the sector more disciplined now? Can we maintain rates on line at a level above our cost of capital, even without any intervening events? Or will we overcorrect like we did in the teens and start destroying value? I think that the hope of most of the reinsurance sector is that the market will act relatively rationally. But we all know human nature sometimes is such that we go down lower than we should. Here's my operating thesis on this, and it has been this really for the last couple of years. It is that there is a floor down there somewhere. And when Julian and Peter wrote the report, Rebalancing, I was reading it, but what I found was that they really do focus right away on structural shifts in the global economy, geopolitics, macro, technology, and trade. And that, I thought, why are we starting with this? The reason that we're starting with that is because that is what drives the global risk premium. All of that stuff, we're speaking on January 5th, so we've just had the events in Venezuela over the weekend. The way that the geopolitical environment, and this of course has implications for SRCC, trade credit, political risk, but believe it or not, it also has implications for property cat and casualty, because what happens with interest rates, as we saw in 2022, is incredibly important. The reason rates went up so much in 2022 wasn't, as we've discussed before, because of Hurricane Ian. It was because of the Russians invading Ukraine, the 400 basis point interest rate spike, and the impairment of capital. So that's why it's so important to understand the global situation and global risk premium. And my belief is that the only way we can get back to 2017 levels would be if we got into almost a disinflationary environment with extremely low risk premia and an inflation of capital. That could happen.
The interest rates are coming down, but they're still real interest rates.
The long bond is coming down. The oil price has gone down today. But I mean, what I'm trying to say is there are a lot of different scenarios that could affect the cost of capital. I don't think the world is going to just become unexpectedly tranquil in 2026 or 2027, which is why we have such a big focus on that part of the market.
One of the other things also is that at those times in the past, we didn't have reports of this kind of quality. We didn't have reporting of this kind of quality. We didn't have data of this kind of quality. So it'd be very hard to be a CEO where all your investors have read this report and saying, your sophisticated investors have read and understood and internalized this report, and they're asking you sensible questions.
That's right.
And you'd be saying, well, actually, before you used to crash through the floor,
That's
now
exactly
you know where the floor is. You only found out it was the floor when it hit you and it hurt.
Right.
Now you should be bumping along the floor. You'll know when it hits you, right?
So if we're economically rational, at some point, the corporate finance theory tells us that the rational thing to do is to buy back shares, pay out more dividends to shareholders, or merge and acquire. That could be the part of the floor, as it were, depending on where the global risk premium sits.
Would you expect to see more of that?
Yeah.
It's probably the big question is, if a broker knocks on your door and says, hey, here's a load of new business for you to write today, would you say, no, actually I'm going to save that money that I would need to write that new business, and I'm going to buy my neighbor because they've got a mature book of business that I can hopefully retain 80% of without too much trouble, and that's a better way of deploying my capital?
It's going to come down to an analysis of the profitability of the relative books of business, of the diversifying effect of the books of business relative, and what that does to your group cost of capital relative to available capital. But yes, you're right in principle.
That's the ultimate question, isn't it now? And the question that the shareholders will be also saying, do you think it's time for a special dividend or a big buyback program or buy one of your neighbors?
Depending on your valuation, depending on forward estimates, that's right.
And on that demand question, it sounds like, having read that very, very macroeconomic analysis at the beginning, it seems like what bodes well is that the demand is suddenly not going to disappear in the way that it has done before, or that the demand will be there. There'll be a bedrock of increasing demand, at least. Obviously, this year it didn't increase by the same rate that capital increased, but demand, the steady increase in demand seems to be there, that the fundamentals for that to happen, whether it's data centers and a huge amount of power or space exploration, all these things are hugely capital intensive. And of course, they will end up requiring insurance capital as well to make them work properly. Yeah.
If you look at the report, again, I'll refer to it. There's a chart in there that just compares U.S. GDP to U.S. P&C net premiums written. And U.S. P&C net premiums written has outpaced GDP quite consistently since 2016. So that does portend more demand for reinsurance. Absolutely.
Yeah. And again, when we look at all these, AI and everything, the amount of investment that's being unleashed at the moment is quite phenomenal. And again, they tend to be things that require insurance capital to be allocated to it.
Absolutely. That's right. There should be more demand for reinsurance.
We're not in a fundamentally unhealthy place. It would seem that there will be an increased demand for our product, both insurance and reinsurance, over time.
I would say that with just the caveat that, remember, reinsurance is a form of contingent capital, and it sits alongside equity and debt. So I think that reinsurance is still a very good deal. In fact, increasingly a very good deal, but it really is always priced relative to equity and debt. So if yields unexpectedly fall, that will increase capital supply.
Yeah. And
then reinsurance as contingent capital becomes less necessary. But I think that scenario is unlikely. I think that given the volatility and risk premium in the world, reinsurance is going to continue to be an incredibly integral tool for all these companies.
One thing was about that reset that we had at 1123. It was almost, just in very crude terms, the way I think about it is the reinsurer said, look, this potato we've been holding on your behalf, everybody, the cedents, it's really hot now. You can just have it back. Yeah. And it was kind of, ow. The cedent said, ow, that hurts.
Yeah.
That hurts. I don't want this hot potato either. And now, of course, we're talking 3 years later.
Right.
A lot of those cedents have got better, got some oven gloves, and they've learned how to handle that hot potato. Is that partly why some of them didn't come back in the market? Because they'd been forced to be better at managing some of that, particularly what we used to call secondary perils, the frequency of smaller cats, that kind of stuff, that they've basically re-underwritten their books, or they've learned a lot of new skills, and they're thinking, I don't necessarily need reinsurance for this anymore because I'll use the reinsurance for other things, like for the really big one, of course, absolutely. I might get a new top layer, but not the sort of, I don't need them to take this problem off my hands because I've done that by re-underwriting my book in a more prudent way.
I think that's right. I think that there have been cedents who have re-underwritten their books quite successfully. Again, it depends on the line of business. I mean, you saw the big cyber remediation or casualty remediations of the last couple of years or several years. And so yes, that's correct. The other thing, though, is that when we were in 2022, if you will, before some of that happened, we were in a world where interest rates had just spiked.
Yeah.
And the cost of other forms of capital was a lot higher. Now they've moderated, certainly on the short to medium end of the curve. And what that means is that by contrast, I'm sorry to keep going back to this, you've got a cost of equity here and a cost of debt there. Reinsurance rates went up by 37% at 1/1/23. They've given about half of that back by now. You're going to sit down and have a rational discussion with yourself, given the cost of other forms of capital, and say, should I be buying more reinsurance now? Should I bank the savings and buy more reinsurance later in the year? Shall I wait and see what happens? And I think many cedents decided it is time to buy more. Others said, well, we'll wait and see, given the cost of other forms of capital and the remediation that we've undertaken in our books and how we feel about the market now. So there's still, if you will, some dry powder there on the demand side of the curve, which could also contribute to there being some sort of...
But certainly, I didn't read anything in this report about a kind of cheap reinsurance-led softening, for example. We're not there, are we?
Not at all, no.
We've had that in the past. We've had, hey, well, reinsurance is so cheap now, I can make my insurance much cheaper, therefore we're just going to go down this spiral together.
No,
that's certainly not been the vibe I've been getting from reading your report. That's never going to happen, right? That's not happening this year.
Never's a big word, but that's not what's happening now. What's happening now is that we've gone back, and I'm using property cat here, but in property cat, we've gone back to the pricing levels of, as it were, 4 years ago.
Yeah.
And remember, 4 years ago, it would have been January 1st, 2022. Pricing wasn't low relative to the trough at that point. If you want to think about it in historical terms, we're not far off from where we were, by our estimation, at 1108. So 1108
not bad at all.
Well, at that point, we'd come down quite some way from the peak of post-Katrina, 1106. We'd had a couple of down renewals, but we're pretty close to that same pricing point. And that was roughly the pricing point that was maintained throughout the late 2000s and early teens up until post-Hurricane Sandy. I heard somebody say, listen, if this was the market that I had to commit myself to as a reinsurer for the rest of my career, I would take it.
My pension's safe.
Yeah, well, it always depends on events, but it isn't as if pricing is depressed at this point. I think that if you're taking a 30-year view, you would probably say, okay, pricing is still relatively elevated. We're not far off post 9/11 pricing.
So it's pretty good. Basically, it's pretty good. It's not to say you've never had it so good, but it's pretty good, and you would accept this.
Let's not forget that 1123, again, this is by our estimation, that was the highest property cat rate online since the era of cat modeling began. So if you're comparing yourself to 1123, that's quite
it's not a bad place.
A difficult comparison. Yeah, not a bad place to be.
The casualty question. Casualty seems to be the last sort of holdout. If we can say, we describe the US casualty reinsurance market as a flat renewal. So if everything else is down, casualties stayed relatively flat. Is that just going to be the final shoe to drop? Would you expect that to drop, or is it illustrating anything particularly?
What we said was overall capacity remained steady. Most treaties renewed at expiring terms. So that more or less flattish in the U.S. That's different. That's a contrast to international casualty and London market casualty. But it's also a contrast, again, to what happened on 1123. If you remember then, we had people telling us, we don't want to write any property, give us some casualty, right?
Yeah.
And it's almost as if that has reversed at 1126. People, particularly regarding U.S. casualty, are more concerned because of the strengthening that's taken place in calendar 24 and 25, and they're more cautious. International markets were quite different. I think it might be too early to say the shoe is going to drop, but as we've discussed before, we have been now for about 24 months, I think, the outlier in saying it's not reserve-ageddon. We think that there's actually plenty of room to make money, including in U.S. casualty, if you know what you're doing. You don't want to jump in with both feet blindly, but you definitely can make money in the class. And so that doesn't feel like a market that's going to fall off a cliff. it feels like a market with discipline where some are taking a wait-and-see approach, to be clear, but where there's definitely economic value.
What do you think about momentum now? How does this bode for the rest of the year? 1st of April, 1st of June, 1st of July.
Yeah.
What's going to happen, all things being equal?
Well, we said conditions are expected to persist into 2026 in the absence of major macro or sector-specific events.
So, not a massive, if there's a huge loss,
well,
obviously all bets are always off.
Right, but I guess that's the real key here. Assuming a world in which all other things remain equal, then of course we would expect conditions to persist all the way up until we hit the hurdle rate, wherever that is, and then we would hope that the market would act rationally. But it just seems to me manifest, given the world that we're in, that we're highly prone to macro events. Given the world we saw this time last year with the Palisades and Eaton fires, we're highly prone to increasing secondary perils, so I wouldn't bank on it. But yeah, I guess if you want to draw a straight line, then it's not as if capital levels are depressed. It's not as if costs of capital are necessarily elevated relative to where they were in the recent past, so we would expect to see conditions persist. I think the more interesting broad discussion, more than 1.4, 1.6, or 1.7, which will themselves be interesting, is what's going to happen 1, 2, and 3 years out. That's what people really need to know in order to plan. And for that, I think you do have to have an assessment of global risk premia.
Things will probably carry on the way they are.
For the next few months, yes, unless something happens. For the next 3 years, I think that we need to have a broader analysis of global macro conditions, of the geopolitical environment, and of course also the environment around secondary perils and costs of capital.
David, it's been really, really interesting. This kind of discussion often throws up more questions than it answers. I think that's what's so fascinating, and that's why I've got to drive everyone back to read that report, because it's really rich. It's full of all sorts of fantastic bits of information and some really good charts, and a good way of starting your year. I'd recommend to anyone listening that they invest some quality time in really reading that and rereading it, actually. So, David.
Thank you very much. I appreciate it.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance podcast is produced in association with Advantage Go, enabling enterprise scale underwriting through a single pane of glass. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.